Welcome to The Landscape, George Smith Partners podcast. Hello and welcome to The Landscape. This is George Smith Partners podcast. Today we have some very special guests on. But first, of course, I'd like to introduce David Pascale, my co-host.
Glad to be here.
And my name is Evan Kinne, CEO of Access Capital, parent company of George Smith Partners. With us today from our Bellevue/Seattle office is Matt Fisher. Matt has been with the firm now for a little over a year, I believe, and has been doing a great job up in Seattle area. Matt, why don't I flip it over to you to give a little bit of a background on our special guest today?
Yeah. Hey, thanks. Good to see you guys. And we've got Parker Nicholson, very well known here in Seattle. Parker's the senior managing director at Legacy Partners. Their office is in Bellevue, like ours. And known Parker for several years. He was kind enough to come on the podcast today. And I think, we've got a pretty timely topic to discuss. And I'd love to hear more about Parker and how he's structuring the capital stack today on the projects that they've got. But before we get into it, Parker, would you like to give some background on you and Legacy and what's keeping you busy today?
Sure. Born and raised Seattleite. Have been with Legacy Partners for going on 13 years. Legacy is an offshoot of the Lincoln Property Company. Our organization's been developing up in the Seattle region for over 45 years. We're headquartered in the Bay Area. We have offices in NorCal, SoCal, Dallas, Denver, Seattle, and we have a new presence out in the Carolinas. Typically build somewhere between $500 million and $1 billion in volume per year. Obviously, on the lesser side, now that we're I'm in the middle of the current down cycle, and we're just completing about 900 units of mid-rise housing in the Bellevue, Redmond area, and are underway on about 400 units of low-rise garden product out in the suburbs of Seattle, and are hoping to start another couple hundred units here in about a month. So we're active. We've had to get creative to stay busy, but finding ways to get shovels in the ground. So
that's awesome. What we thought would be an interesting topic, and Parker has a ton of experience in this arena, is how difficult it is today to find LP equity and bring that into the capital stack, especially in ground up. And Parker, I know that you guys you structure your capital stacks pretty traditionally, like we were saying before we started recording here. And I think that you, more than most people, know how challenging it is today to go out and secure LP money. And so I thought that would be an interesting thing to discuss. And you're more well versed in that area than most. And so I thought maybe we can just get right into it. But how hard is it to find LP capital today in this environment for ground up construction?
Sure. Well, I think it would be helpful or useful to backstep and look at the environment in 21, 22 when we were capitalizing our current Bellevue Redmond projects. I mean, we were looking at, sub 5 going in yields on costs with, 14 or 15 term sheets that were very aggressive from LP capital partners, many offering, sub 9% pref, zero cost, overrun exposure, et cetera. So pick of the litter, essentially. Fast forward to today, obviously a very different environment. Almost impossible to get a deal done. If your story is a commodity story, we've had to get much more creative in our deal structuring and sourcing. We've decided to get back to our roots of, tried and true suburban, 3-story walk-up housing with, a cost basis sub 300,000 a door. We've, found ways to partner with landowners. We've looked at, much more exotic ground lease structures, et cetera, to try and get yields high enough to attract attention, and have gone out with brokers candidly to find equity, and have found it challenging to have that story of needing to have that third party tell the equity story in this environment, and ultimately decided to hit the road and had over 30 equity tours, individual equity tours over the course of 10 plus months before I was able to successfully capitalize a 240 unit garden project located in one of the nicer suburban garden submarkets of University Place, south of Seattle. It took I'm an honest 7.5 going in yield, a developer's 7 3/4 going in yield. It was, sort of smushed down to a 7.5, and it took a very exotic ground lease structure that allowed me to control land at a essentially a 50% of market feasible value basis, with a very, very developer or leasey friendly ground lease structure that allowed for about 150 years of total control on the site, and no unpredictability or volatility in the ground lease payments. It was all just straight 2.25 annual rent bump, no resets, no reappraisal rights, and really took a combination of that kind of unique offering that allowed me to get my total cost basis down to where there was a defined margin in this current environment to get a deal done. I mean, I would also say that really helps to have great longtime partners. I mean, it turned out that our LP equity source on University Place was, a group that we had, previously to our recap done many co-GP deals with, and after, hitting the road, discovered that they had a bucket of money on the LP side, and that's really blossomed into a bigger relationship, and much more recently, we actually just announced we're starting construction on another project out on the Kitsap Peninsula. Similar story, fee simple, in lieu of the ground lease, but the hook there was that we were taking on a project that had been taken back by a hard money lender, deed in lieu of foreclosure. A lot of site work had been completed. There's a lot of value in the land that, it really took our group just kind of getting our arms around, fully understanding all of the horizontal improvements that were already in the ground, and realizing that we were, essentially able to buy this property at a 60% of actual cost basis. And that story, again, helped us compel equity to take the leap in this current environment, knowing that we were vested under, a prior energy code, prior IBC, and had the economic advantage of starting construction and going vertical almost immediately, which will allow us to hit a much higher IRR threshold, given we're not, spending 5, 6, 7 months doing the horizontal improvements before going vertical. So the overall construction duration is significantly shortened, which is, again, allowing for those higher IRRs. So let's say the story is dramatically different on the mid-rise core type deal profile. I mean, we have very choice sites in the greater Seattle area under control that we're working our way through entitlements on, a 180 unit deal the check size being much more palatable, and in that 35 to $50 million range versus the larger podium offerings. Um, you know,
So,
very.
so on a deal like that, I mean,
Yep.
when you find a project that you think is a good fit for Legacy and you guys want to pursue it, maybe on your Port Orchard deal or University Place, how many LPs are you going out to, and how many are you actually
Sure.
getting term sheets from?
Sure. On University, I canvas probably 60 or 70 LP groups, and I believe I did over 30 equity tours before I found
Jeez.
my love interest. So, uh, but it really took a group willing to sit down and fully understand what we had accomplished with the landowner and the unique value inherent in that structure. I mean, we were essentially um, financing the dirt for about 4.5% cost of capital versus a blended cost of capital of the deal of 11, 12, 13. So you know
So I wanted to ask something. The ground lease structures, we've seen that, and definitely they're innovative. It's really matured in recent years. Can you, on the one you mentioned, was it two questions? It
Mhm.
was a 150-year ground lease, and number two, what was the return with and without the ground lease? Just round numbers.
Sure. So the ground lease was 99 years with 5 10-year extension options. That
Okay,
was
to make it
a structure
140.
we had to put into place to get title to endorse it. So that was how we got to the 150-year mark.
Right. Okay, understood there.
The fee simple value of the land, arguably speaking, at that time was somewhere around, call it 30 to 35,000 a door for the dirt. Using an implied interest rate factor of, I don't know, a 4.75 to 5.25. We felt we were, controlling the dirt for a cost of capital. There was somewhere, closer to, sub $20,000 per unit, essentially. And with the ground lease, again, we were, underwriting to a, 7.75 untrended yield on cost. Our LP had underwritten it to a 7.5. Little unclear what you're looking for in terms of an answer.
And what would have been without the ground lease? What was the return?
Sure.
Yeah,
So if you took out the ground lease and you replaced it with, again, that 30 to 35,000 a door metric, you were slightly below a 7 yield on cost.
got it.
So you're kind of in that danger zone. Like you mentioned, what we've seen, it'd be interesting to hear if you concur with this.
Mm-hmm.
It's very difficult to do JV equity today.
Mm-hmm.
It's really tough for ground up construction.
Sure.
So the deals that are getting done seem to be that sweet spot check size. I'd call it 20 to 40 million
Mm-hmm.
check size.
Yep.
And then also really tough right now to get anything done that's a podium construction
Mm-hmm.
or anything fancy.
Yep.
And just because even that 25 basis points of movement or 50 that you get, because the more expensive construction type basically
Yep.
wipes it out. And I think like you said, stuff will get done. It's impressive to me that you got this done with the ground lease. Obviously, you worked really, really hard on that. For whatever reason, ground leases they just draw a little bit of concern from folks. Although, statistically, I guess that there is a little bit of a cap rate discrepancy for a ground lease
Mm-hmm.
project at sale. So you guys probably underwrote 15 bips for that or something like this.
Well,
Or
I would argue that in a good real estate market, there's little to no discount for a more cap rate premium for a ground lease.
right.
In an uncertain market, like the one we're in today, it's somewhere in the 25 to 50 basis point range. But that's, again, you need to really dive and distill down to the core elements of the ground lease. I mean, people are concerned about ground leases due to the uncertainty of the future cash flows and how they're impacted by the ground lease structure. Along with the fact that you're going to lose control of the improvements at some point down the road. But I would argue that with, fixed 2.25% bumps that are below historical rent inflation and, the ability to control the land for 150 years, is arguably better than owning the land fee simple at a higher cost of capital, and thus should deserve no, sort of cap rate premium. If you actually, I'll get down to the nuts and bolts of the actual deal itself, but you are correct that it's a gating issue. A lot of investors just when they hear the word ground lease want nothing to do with it. So, it took a group that understood the underlying financial impacts of the ground lease structure, and we hope to sell the asset in better days ahead. So,
And speaking of selling, when your typical LP, what is their horizon? We know
sure.
if you're with Neisters in the old days, they would want to own it forever with you, New York pension fund. But now it's 5-7 years at most, right? And so are they underwriting to a sale? Do they look at a Fannie Freddie loan and then a sale? Kind of
Sure.
sure.
So we have a myriad of different LP relationships and many with different strategies. I would say the groups that are active today are more the merchant build types that are looking to take advantage of the dip in subcontractor pricing, the lower basis, and are hoping to sell, call it 2 to 3 years after stabilization.
Right.
Many of our more, sort of life co type, profile investors are longer term holders. They're underwriting, some sort of an agency takeout down the road, and I want to hold it long term. So,
right. It's all tides.
Yep. But I would say that again, those that are willing to dip their toe in right now are getting the benefit of subcontractor pricing that is bottom of the barrel. I mean, we're having subs who are pricing work zero margin right now. So I really don't see how it's possible to have a further decline in construction costs. I think we're at the bottom, and again, there's few select groups out there that understand that story and are willing to dip their toe in. I agree with Evan that the podium mid-rise space is entirely different. Most of the deals that I'm getting done are, again, 3-story walk-up, air-conditioned walk-up, well-parked, well-amenitized, but again, $300K and below basis product. Somewhere in that 6 3/4 to 7 fee simple, 7.5 plus on a ground lease type deal profiles.
And all the wood frame construction and not a
all
lot of subterranean, just all the good, like cheap.
It's all
or-
slab on grade product, but we're not spinning it as such. I mean, we're bringing podium quality finishes to garden. We're bringing air conditioning to garden, which is not typically market in the Northwest up here, until very recently. And we're bringing a little bit more of a sophisticated aesthetic to our product as well. We're not building the standard builder grade commodity garden that you see across the country. I'm adding a little, some additional design aesthetics that are hopefully going to elevate the product to be a little bit nicer than what's been built previously, and kind of bringing some of that podium level quality to the garden space, essentially. So,
I think something you just said is a good segue into another topic. You mentioned that you feel like we're at the bottom in terms of construction prices. So, we were talking earlier, Parker, about kind of your outlook, and when do you think we're going to be back in an environment where this kind of LP equity is more abundant and we can have an easier time bringing into deals? I don't have a crystal ball. Nobody does. I think David Pascale, you have some really intelligent opinions on where you think the market is. And Parker, I'm kind of curious from
I
your
follow interest
perspective
rates a
too.
lot, but
Yeah.
hard to say right now.
Nobody's got a crystal ball. I'm curious what everybody thinks. I mean, where do you think we're going, and what do you think the next couple of years look like?
Yeah, well, I'll start. The the headline news in Seattle, oftentimes mentions, a mass layoffs at Microsoft, Amazon, etc. If you actually kind of dig into the recent BLS data on job growth, Seattle actually has positive job growth right now, positive net in-migration. So, of course, that's to be determined regarding the recent tariff impacts, etc. But generally feel like the macroeconomy in my region is doing quite well. Our issue, has been, we built a lot of product in 21, 22, 23, especially on the east side in the Bellevue, Redmond, Overlake submarkets. We're getting strong absorption, but it's requiring, elevated concessions to kind of work through all that supply. And we're just starting to see, green shoots and a little bit more pricing power and really hoping that maybe it's not 6 months out, maybe it's not 12 months out, but somewhere in the, call it the 18 months to 2 years out range, we'll be back to business and building, a lot more core product where, we're bullish in that we're tying up sites with 2 to 3 years of control and working our way through the process and really hope to hit that, call it 27, 28 window. I think 26 is going to be, tough. So,
Yeah. It was survived 25. Now survive maybe through 25.
Yeah.
It was going to be survived through 27. No, I think just,
we have a good tailwind on deregulation.
Yeah.
A couple things. There's been, we see M&A, popping up, and that little bit of the return of the animal instinct. So, developers, and I think developers are realizing the rate environment is going to be, the 10-year treasury is maybe at its hidebound range.
Yeah. And at some level, our business is just a huge interest rate play, right? So, I mean, you can see this,
The biggest component,
right? I mean,
like the cap stack.
really makes a difference. But let's talk a little bit about, what I'd love to switch gears a little bit.
Sure.
And let's talk about, you guys just went through your philosophy and like what you think about in terms of, elevating the product and whatnot. But let's talk about like the climate there when it comes to getting your entitlements and some of the regulatory changes that have happened. And also sort of the big looming question, which is affordability of housing. And just to kind of narrow it down a little bit further, housing affordability is constantly in the news. And there's a lot of finger pointing in the news. And, depending on where you're sitting as a consumer, we just did another one of these fine podcasts with someone in the build to rent space. And, obviously a lot of ire driven towards those players. But the bottom line is they're producing new housing, right? And supply and demand. So would love to hear your thoughts on that. I know it's probably a little bit of a hot topic for you.
Sure.
So, skirt around it if you need to, but would love to get your thoughts.
Sure. Well, I'll start on the affordable housing front. I mean, so the biggest obstacle that we face is just a long and protracted entitlement and permitting process that introduces a lot of uncertainty to our business, a lot of carrying costs to our business. And I will say that surprisingly enough, the city of Seattle proper think, has made the most progress towards kind of moving to a more expedited, developer-friendly entitlement and permitting process. They're suspending design review board. They're often cases suspending the need for a SEPA process, and what was once I don't know, a 22 plus month process can potentially be done 6-8 months
That's
quicker.
great.
So that's the good news. The bad news is that, there are jurisdictions on the east side here that, have introduced, layer upon layer of uncertainty. And, it's very difficult for a group like ours that has a philosophy of never buying land until we
So you're
have
ready to close.
ready
Let's
to
go.
close. And,
Go vertical.
we have stuck to that mantra for 40 plus years. And,
Right.
I don't think we'll change until no one's willing to give us an option agreement, and that hasn't
Right.
happened yet. So we're still in business, but it's very hard to convince or compel a landowner to offer, 3 years of control.
Sure.
And we've been through a few entitlement processes here where, we've used every bit of that time, which is just unacceptable. And there are developer consortiums up here that are working together to try and make change happen at the municipality level. And I'm encouraged, but it's still a major challenge.
Sure.
On the affordability front, I'd say that, typically speaking, we're either participating in a multifamily tax exemption program, which would be in the city of Seattle, or there's a mandatory inclusionary housing component, which is often prerequisite of the zoning requirements for the Bellevue, Redmond, Kirkland, Mercer Island submarkets in my region. And typically speaking, those requirements are a mandatory, pay to play 10% of the unit mix affordable to, X percentage of local area median income. What's interesting, we're finding there's been so much product delivered that the folks that are, they're looking for that housing have the pick of the litter. And we have very fine, open 1-bedroom units, which is a product type that's somewhat unique to the greater Seattle area, where I can't lease that housing at a 70 to 80% AMI level because there's so much of it that they would all prefer to pay the same rent for a typical, standard 1-bedroom unit. So,
Interesting.
I'm not so sure it's a affordability issue as a, can I afford the right type of housing issue? Can I afford
So there's some discretion there, is what you're saying.
yeah.
Right. Yeah.
And that's a point in time, not saying that that's a long-term, sort of, take on the market, but
Sure.
we're,
That sounds like the broad view, though, stepping back, is that there is some green shoots, like kind of recap,
Mhm.
on the sort of deregulation side, potentially. And I
Mhm.
think, as you mentioned, introducing new variables to the process is just never a good idea, because I think that the folks that are pushing for that, they're well-meaning, right?
Mhm. Mhm.
But they don't think they have a grasp on, like, the capital process and what
Mhm.
that actually means in terms of structuring a business that
Mhm.
has to sit there on, potentially on the land for years. That can just be absolutely just a death knell to a
Yeah.
development company. And so it's interesting to hear your guys' philosophy that you stayed away from buying land. It's pretty consistent with your peer set, the
Yep.
top sort of merchant builders for this
Mhm.
type of product.
Mhm.
But obviously not all real estate can get built that way.
No.
You guys have some scale, and you also have a pretty good machine. But
Mhm.
on more bespoke projects, difficult entitlements, sometimes there's just no way around it.
Yeah.
And people want to see that stuff built. Um, but it's just, this is like this is the big question. So we'll see if we see how it goes, huh? Matt, do you want to change course here, or yeah?
Well,
Flip it to you, Matt.
I did just have a question. In the beginning of the call, Parker, you had just mentioned you guys have a lot of offices in major markets around the country. So I'm
Mhm.
curious,
Mhm.
you know, on I guess it's a two-parter. One, are there any markets that seem to be like overcooked or just that people are really struggling to find projects? I mean, it's not
You get me
easy
in trouble with
anywhere,
my
right?
partners. Yeah,
Okay, so
yeah,
we
yeah.
don't have to. I don't want to get you in
No,
trouble, but I'm just kind
look,
of curious. What are some of the more challenging markets relative, and how does Seattle differ from those other markets around the country?
sure. I would say that obviously, it's no, it's not news that investor focus, leading up to COVID, was intensely, set on the Sun Belt.
Hmm.
We had a lot of activity down in Texas and in Florida, and I went so far as to expand into the Carolinas and into Nashville. I would say that we're finding it difficult sledding down there right now. The supply issues down there have really impacted the market, and we have a really attractive deal outside of Dallas with very creative city financing and subsidy and a 7+ yield that we've had a little bit of of early difficulty in getting investor interest. So it's been tough in the South. I would say that we've been most active in the call it LA South, Orange County, San Diego markets, and up here in Seattle. We're finding the Denver's still overheated and oversupplied and quite challenging. But we're having I'm hosting equity in town in Seattle. I'd say on every other week I have a group wanting to come in and at least begin the conversation about deals, which is a dramatic sort of change in the environment
That's
in a
good.
couple of years. So
Yeah, I mean, we've seen it picking up a little bit too. I mean, there are definitely some green shoots. I'll tell you, real estate is obviously cyclical, and like we were talking to earlier, a little bit levered to interest rates and macro more than probably some other industries. And
mhm.
so, in terms of longevity, I think, and just giving something to our listeners here who could be, probably a swath of lenders, private equity investors in the commercial real estate space, and of course, real estate sponsors. And I think just to kind of pull the conversation together and wrap it together here, what I'd like to hear is just like give us like in a very brief nutshell what you think the top 2 or 3 philosophies that have contributed most to Legacy's success
Mhm.
over the last 40 years. Because from our vantage point, we sit in a unique spot. David's been with the firm for like 30 years now.
Yes.
And just seeing the ebbs and flows of people who get in the game, get out of the game, and they
Yep.
oftentimes get out not wanting to get out. Right? They're going out feet first.
Right.
Yep.
So,
Yep.
why don't you I'd love to kind of just try to wrap it up here with
Sure.
that question.
Sure.
Top 3 philosophies that you guys have employed there.
So I would say embrace and really protect long-term relationships in the business. I mean, we like to do a lot of repeat business. Um, we have a very solid stable of a longer-term partners that we really cherish. Would say number 2 would be kind of stay in our lane, stay in our box. We're old school. We don't typically gas the cap stack with a lot of higher octane, you know, pref equity, mezz equity, or sorry, mezzanine financing,
Right.
et cetera.
Fixed cost stuff.
Yeah, we're, typically going out and getting, 60% loan to cost, non-recourse financing, which unfortunately, in the last couple of years has turned into partial recourse financing to hit those leverage points and
Interesting.
filling out the rest of the capital stack with, very traditional LP type money and trying and hammer out one set of JV docs and not spend $1 million on legal every time we do a deal and try and repeat and do deals with groups that we know and trust over and over and over again. So I'd say really just staying disciplined and understanding that whatever market fat is out there, that may be, able to at that point in time pay more for land than you can, or achieve outsized returns at that given point in time by introducing a more risky money into the cap stack. We've survived by just doing it the old-fashioned way of putting one foot in front of the other, staying disciplined on optioning land, and finding 2 or 3 high quality general contractors that we like to work with, and and
it sounds like also not buying unentitled land, right?
not buying unentitled land, not carrying land, and again, not every deal's for us, and I'd say can tell you right now, I mean, I feel on the sponsor side, it does not feel like a down market. I mean, I'm
Right.
out there participating in bidding processes for land on the greater east side here, and I'm underwriting a lot of choice sites, and I'm really struggling to understand how my competitors are getting to some pretty nosebleed land valuations in the
Some of them might not be your competitors next cycle. So
maybe not. I wish them the best of luck, but what I find interesting is that we're all out there trying to show a 6 yield on cost for close in sites, podium sites, etc., which apparently is the Mendoza line that you need to hit to get a deal done.
Yeah,
6.25 for the best sites, the best locations of Seattle. Yet products down the street are all selling as stabilized assets for $450 a door, and yet we're proposing to build brand new at $450 a door, and you wonder,
right, tough math.
Tough math, and how is the developer underwriting to a 6, and yet the broker's reporting that same basis as a 4.5 cap?
Right.
Right.
So, really have to sharpen the pencil, the pencil, and stay disciplined on the underwriting side. And again, we're finding a lot more success out in suburbia doing lower cost, lower risk deals, and we'll pick off the right deals with the right levels of control and the right structure to hopefully see us through the next cycle for mid-rise. And if it doesn't come in that 27, 28 time period, a lot of people will be hurting up here, because there's a lot of positioning going on right now, and be interested to see who's right, who's wrong.
All right, well, we better wrap it up here. Really appreciate you coming on today. Yeah.
Thanks for having me.
Where do people learn more about Legacy Partners?
LegacyPartnersResidential.com, headquartered in San Mateo in the Bay Area. And we also do third-party property management, have about 20,000 units in management. We built about 80,000 units as a company since inception. And we're
great.
That's fantastic.
Cool. Well, thank you again. Just for our listeners, remember to go to dspartners.com and sign up for FinFacts. Of course, subscribe to this podcast wherever you can get it. We're on all the platforms. So,
yes, we are.
All right. Thanks, guys.
Thank you.
Thank you.
Thanks, everybody.